The market is looking much better today, thankfully, from the other day that I was on. The reason, of course, is that in the US we did see a rally towards the end of the week, and a little bit of a rally was sort of overdue in the Indian market as well. One of the things that I am now looking at, a lot of the comments that were going around, if you, for instance, take a worst case scenario and discount the entire cash flow for the next 2 years from most of the companies that we track, it does not make a substantial difference to the prices as they are in today's conditions. So, to our mind, the prices have been beaten down far enough, and I think the comment that it could perhaps go down another 15% is not entirely out of the question, but need to put that in perspective, because in any given 6-month period, the stock prices of any stocks tends to sort of fluctuate between that range. So 20% up, 20% down. So I don't think we need to take that thing too close to heart.
Stock specific trades right now.
Actually, we are very happy to see that some of the better players in the realty space are getting picked up today. We do like DLF, and one of the things it's perhaps easy to forget in times of panic like this, that there are businesses underneath the stocks that we actually trade on a daily basis, and these companies, for instance, DLF has a very strong land bank, so its core business is unlikely to go out of favor. What we might see, or what we will see rather, is some amount of margin pressure in the short run, where they might have picked up some of these land at a higher cost, and we may not be able to realize fully on that. But as far as its fundamental business is concerned, it's very strong, and if you can get it at the prices they are available for, that's very good. DLF is actually part of our core portfolio that we are recommending.
Raj, I must admit you're one of the extremely few people who have said that they like DLF or perhaps any real estate stocks, and this includes not just today or yesterday or the previous 1 week, but in a long time now. Talk a little bit more about that, Raj. Why do you like DLF? The stock's at 214. There is still no clarity as to how much more property prices will fall from here on. Are you valuing the company just based on the land they have, the intrinsic value of the land, and saying that, well, the stock's now extremely attractive based on that?
Yeah, I think that's part of the thing. What we like to do is step away from the stock and focus more on the underlying business. And as far as DLF is concerned, it has some of the best land, and as you know, it's a unique sort of a commodity. So if you can get a well-run business at a price that is really attractive, I think it makes good sense. Of course, I do speak for a retail audience. We don't do much of the short-term institutional kind of work. Just to put that that call in perspective, BSE Sensex on a simple average basis has come down in PE terms from 43% to close to around 11.5% last week. That's a 73% drop in valuation. And what that means is that for each rupee of earnings for each of these companies that you have, you need to pay 73 times less for the same rupee of earning. And that, I think, is a very attractive proposition if you have a little bit of a long-term perspective, which we consider around 12 to 18 months. I think would certainly do that.
Raj, let me just go to you with what Dharmesh said. Would you agree that the similar case will happen? Dollar could go half from here. And if so, the currency implications on companies like Infosys, the management earlier came on the channel and they indicated slower growth prospects. Yesterday, CLSA came in and downgraded the EBITDA and EPS estimates as well by as much as 11% in the next financial year. What would you do with these IT stocks?
Okay, let me start with what some of Dharmesh was mentioning. Clearly, there is a structural issue in the U.S., which in India, thankfully, we don't have. The issue there is something which is in the financial institutions that they have is what's been popularly known as the Greenspan put, which is basically that whenever the U.S. Financial firms have gotten into trouble, the Fed has stepped in to bail them out, and this time, of course, is no different. So that is the structural change that would at some point happen. It's very clear to me that it's not going to happen in this cycle. There are like fundamental challenges in terms of how US utilizes debt both at the domestic level as well as at the government level, and those are things that I see playing out over the next few years. And will have an impact on the market, but nothing certainly at this time. We were talking a little earlier about the historically low interest rates that we have seen. The kind of liquidity that has been pumped in right now is at historic lows, and to my mind, I think we have overdone this the interest rate cuts that we have seen across the world. Another thing to keep in mind is that this particular downturn is a little different structurally from some of the earlier ones, in that a lot of the petrodollars as well as money out of China has not gone through some of the wealth destruction that Dharmesh was talking about. So that's again money that is ready to be deployed. And when I'm speaking, and again very anecdotally, to folks in the US now, there is much more of a sort of an optimistic view on the markets in the US, which genuinely has problems. So to my mind, I think that people are just waiting to take the plunge and not taking a trading call, but it is given how oversold these markets are. There would be money that be looking to find a home, especially in countries like India, which can give them the kind of growth that they need to grow their balance sheets. So initially, like there is going to be some amount of money that is put aside to shore up the institutions' domestic balance sheets. But at some point, they have to grow, and to do that, they have to look for countries like India, which can afford to grow at the rates that it does, and especially in infrastructure. The kind of money that India can absorb in infrastructure is simply not available elsewhere in anywhere in the world. Yeah. So one of the things that Dharmesh also alluded to, the stock prices tend to be forward-looking, and so one of the clear signs that the bottom has been reached is when additional bad news does not really impact the price on the downside anymore. And that happens because we've already taken into the price, discounted from the price, the 15 to 20% reduction in prices that we want the realty companies, for instance, to be making. So at some point, the points like this in the cycle are nothing more than a test of conviction, and that can only come if you look at the balance sheets of the company and look at the execution record for the last 10 years or so, and the companies that make through that screen, I think are good buys. One of the interesting sort of little studies that we did in the last few days was to look at companies that are priced under the price to book value. And there are 160 companies in the BSE 500 that are trading below the price to book value. Interestingly, we were looking at the BSE 500 stocks, and there are 160 companies that are trading under their book values. The clear thing for us at this point in the cycle is to look first of all to the balance sheet, and if they can do well through the down cycle and then come up. Perhaps not that surprisingly, the market has done a very good job of the companies that do meet that criteria are actually not been beaten down below their book value. So only companies with a good amount of debt on their books, the interest coverage ratio, which is on the lesser side, actually less than 1 in the majority of these cases, those are the ones that have really come under pressure. There are companies that we did find, but not the ones that are beaten up so badly. We find ROIC as a measure is throwing up a good number of companies. We put a screen for ROIC of more than 20%, and around 185 of that same universe actually qualified. So those are companies, and again combined with a very strong balance sheet, are the ones that we are really recommending our clients to look into.